All right, everyone. Once again, the topic is Collections 2.0, compliance, first collection plus gamification, UPI-Pull and conversational AI. And for the same, I would request the moderator to join on the stage, Mr. Abhishek Arun, President, Platform Strategy and Commercialization, M2P at Fintech. Let's have a huge round of applause, everyone. And now I would request speakers to join on the stage, please. Mr. Abhisar Sharma, Managing Director and CEO, NESL Asset Data Limited. Let's have a huge round of applause, everyone. Mr. Brendan Lee, Chief Credit Strategist at ConfirmU. Let's have a huge round of applause. Mr. Deepak Jain, CEO and co-founder at FlexiLoans. Let's have a huge round of applause. And Ms. Presha Paragash, Wholetime Director and CEO at Credit Saison India. Let's have a huge round of applause for her. I would request Mr. Abhishek Arun to kindly begin the session.
Hi, good evening. Good evening, everybody. Thank you for making it to the session. I believe there is a parallel RBI governor session as well, so thank you all for making this. It's an interesting topic, Collections 2.0. One of our fellow panelists said this, that are we in the business of lending or are we in the business of collecting? So I'm kind of stealing this particular statement. For any lender, you're actually in the business of collections versus really disbursing the money. That's an easier part. I'm sure our credit friends would say disbursing is also not easy. There is a work around that as well. But collecting is the core to how the business will run. So we have an eclectic panel here where two of them are running lending organizations, one looking at gamification and international exposure to how collections is being done in his area. And we have a friend who, looking at an organization from a data perspective, account aggregator. So varied mix of things around the collections perspective. We'll try and cover as much ground as possible in a limited time. I think to start off, it's a large market, but the last report which we read about from BCG was $4.5 billion on collections. Give or take whatever NPA numbers you look at, there's a large pool of collections to be done, how it has to be done. And so I think the starting point is that what is the cost efficiency of the collections structure today, and how can we make it more efficient? So I'll probably start with Manish if you want to kind of... Deepak, sorry.
It happens to us a lot when you name my co-founder on the
Yes.
Thank you. So see, collections effectively starts not when you're collecting. Collection starts when you're underwriting the customer. And as I said, we are in the business of collections, or we are in the business of underwriting and lending right, and then ensuring we collect on time. If we don't receive the last two EMIs, the entire money we make in short-term loans, which most of the lenders give, we don't end up making any money. Now, over the years, we used a lot of data science initially to acquire customers right, and underwrite customers right. In last few years, as our collectible pool became larger and larger, we started using a lot of data science and analytics there also, and you can call machine learning, quote unquote. There we've created models now where customers are rank stacked on various levels. So customers who will have a higher probability to bounce, and customers who have lower probability to bounce. Customers who have a higher probability to do the first bounce, again, those customers are sent more messages, more robocalling, etc. So they are prioritized in pre-collection dates over the customers who have lower probability to bounce. Once a bounce is done, again, there we use certain models where we've created, again, what's the probability of these customers being our ability to collect from these customers in the first 30 days, and our ability to not being able to collect these customers in the first 30 days. And again, we use various parameters to, rank stack these customers on various methods that, okay, whether we'll be able to collect from this PIN code, this sector, once the bounce is done, and so on and so forth. So basis, again, cohort data. Once a bounce is done, we, again, prioritize the customers. Customers which have lower probability of collections post-bounce, what we do is we put them to agencies faster than normal. So because we don't have our own feet on street across the country, we'll call the customers where the probability of collection is higher, and we'll put on the agencies of feet on street where the probability of collections is low. So using a lot of data analytics and machine learning to prioritizing the customers is our method or our mode of ensuring that the force or the number of people required for collections is lower and lower. In last 3 years, we have not more than doubled, our teams would have scaled by 1.5 times. Whereas the number of cases which we have to collect, because the loan books have grown by 3x, the cases have also scaled by 2.5x.
So is it fair to say that you're saying that using data analytics and modeling has helped you kind of reduce or create efficiency, or is it?
Absolutely. So it has not only increased our collections, but also reduced the amount of efforts required on every customer, because we are not putting the same level of efforts on every customer. The customers where the probability of default is higher, the first default is higher, you'll end up spending more before the due date as well. Where once bounce is done again, where the probability is very low of collections, you'll end up spending more versus spending same amount of efforts on every customer.
So is there, you do a lot of unsecured in the business segment. Is there some nuance which you're seeing, which you possibly want to share with the audience, which is slightly different and interesting as a tidbit around?
So when you say nuance, what do you mean? Like in which area?
If you say this part of country or this particular business has a higher probability of collections or a difficulty in doing this, what have you seen and surprised you that, oh, this is also happening in the market?
So what's working best for us is multivariate rules in underwriting as well as collections. So these rules which I'm talking about is not at a single pin code level or single sector level. It's a cohort of customers which we create using multiple variables. Again, use a lot of smart data scientists in that. It's not created by business folks like me. So a lot of smart data scientists sit and they create this using many thousands of variables, and it's really working well for us. I'll just give you some numbers. Our first bounce have come down from generally it used to hover around 12.5%. At peak, in the last bad cycle, which went by last 18 months, it went at peak to 14%, has come down to 10.5% by using all this analytics and data we are talking about.
Interesting. Abhisar, you want to kind of chime in from an account aggregator perspective. Is there some play here where collection efficiency improves by using account aggregator?
Wonderful. I would like to spend just half a minute on the account aggregator piece, which is probably the first of its kind anywhere in the globe. So thanks to our regulatory, innovation and I would say foresight, this is probably the only geography in which what an account aggregator does, it actually breaks the silos. Now, all of us know that the entire BFSI of the country, BFSI when I talk about banking financial services industry, is regulated by very important regulators, the Reserve Bank of India, the PFRDA, the IRDA, IRDAI, and the SEBI, and of course NHB to an extent, National Housing Board. So you all be happy to know that your country today supports the breaking of silos in the sense that all these regulated entities, regulated by these 4 or 5 regulators, have whitelisted with account aggregators today, which technically means is that, if I say like this, so account aggregators typically are ensuring the breaking of silos wherein the data of the customer is the king here, basis a simple consent mechanism, can share the data from financial information providers. It could be set of all of the banks.
Are you seeing that being used extensively in collection side as a use case?
Yes, so I'm coming to that. So one of the important cases would be that. But right now, this is something which is being used strictly on the need-to-know basis from financial information providers to financial information users. And now what really happens is the customer is the king here, because the customer decides by giving explicit consent for which the data can be used, for the tenure used, and for the purpose being used. So which technically means, from collection perspective, my friend here would really like this idea, that if there's a provision wherein which you can see the assets of a customer basis the customer's explicit consent as per the DPDP Act, you can visualize account aggregator to be one form of a consent manager. The extent of NPS gets drastically reduced. Because at any point in time, basis the customer consent, again I'm repeating, that's the basic artifact as per the regulator decided, the data can be shared from a financial information provider to the financial information user. and user being an entity which extended loan like my friend here. So imagine a scenario wherein which 24/7 by 365, you can see the customer's account basis the customer this consent and ensure that your collections can be kind of segmented. You see the probability of failing, the probability of ensuring that this is there. You can also reprice your loans to that person, because if you understand that the person has actually evolved well in life, because you probably, for example, gave a loan, let's say 1 lakh rupees you thought you gave, 50% haircut assuming, 50,000. Tomorrow you see that the account balance has gone to 150 or 200, times what it was. You may even price the loan, maybe ensure that the gentleman is giving more incentives to kind of prepay the loan earlier, or maybe it doesn't become delinquent. So account aggregators can actually be a yeoman service, can play. It's a very important case study, a case in the making use case, where they can actually assist these borrowers as well as the entities giving loans for ensuring the delinquencies are to the minimum. Because if you imagine, if you can envisage a loan and the functioning of the loan, the behavior of the loan at your will, basis the customer consent, I mean, that's ideal panacea for anyone to extend a loan to any entity. And it also facilitates through various service providers generation of alternate data, because account aggregators are blind, data blind. They cannot see what is being transferred from one entity to the other. And these are all basically as per Revit standards, encryption standards. So imagine there are certain insights that also flow in as to the customer usage, the usage pattern, how it is being spent. And a lot of alternate history can also be built by the entities which are permitted to do that, to ensure that the loans can be much more better priced for inevitably the customers to pay them well on time.
Understood. Brendan, is there some inputs from an international perspective you want to kind of chime in on?
Yeah, I think I'll start by echoing a bit of what Deepak said. Where we saw lenders take the data science tools and techniques from acquisition and bring them to collections, we're now seeing them do the same with the user experience side of things. I think partly driven by COVID, because it forced a lot of lenders to suddenly say, how do we collect money now that nobody's there to do the job? They started to invest for the first time in front ends. But also, as they've done that, they've started to see, I started my career in fraud, but early in my career worked in collections. And in those days, we try to make collections as scary as possible. If we make collections something people are terrified of, they'll hopefully pay us back. And what we're realizing now is that if we make collections the thing you want to avoid the most, when we try to reach a customer, when we see something starting to go wrong, they avoid us, they don't answer the phone, they're too scared to look at their bank account. By the time we do get a hold of them, it's too late to turn them around in many cases. Instead, we want their money, we want them to pay us money. So if we can build user experiences that work for them, we're more likely to get more money from them. So we're seeing tests with better front ends, with more flexible collections, and in the area we're in with gamification. So gamification is basically just taking the elements of what make a game engaging and trying to build that into your user experience. So you think of things like points and badges and rewards when you reach certain levels. We do this a lot up front. How do we get somebody to go through, in our case, a questionnaire? Instead of doing a 3-minute questionnaire, we give them a 3-minute mobile phone game. But we're really just after the data. And what we're seeing now in collections is the ability to do a similar approach. How do we turn collections, which is this thing people are scared of, and where it can take a while to see the outcome, the positive outcome. People want money that you don't have. How do we break that down into smaller bits so you can give more feedback, you can see them get mini rewards along the way. So maybe they're not looking ahead 6 months until they've recovered the loan, but are they getting points or badges or rewards for answering the phone, for meeting next week's promise to pay? How do we make that experience that is an unpleasant one, slightly less unpleasant? And in so doing, hopefully we get more people earlier on engaging with us when there's still recovery possibilities, when maybe they've got more strategies open to them. So yeah, I think that's what we're seeing now, that wave following the data science coming into user experience.
Interesting. Presha, from your standpoint, one of the KPIs could be percentage recovery for the loans which have gone bad. But at a CXO, CEO level and the dashboard level, what are the various parameters you actively track? Or things which make sense at an overall level, be good to kind of talk about and the audience to know.
Yeah, so I think, recovery is quite a broad term, right? So I think the first part of recovery is also breaking it up to see and understand, what is it in each bucket that we are also seeing in that sense. But I think the second part of recovery that's very important is also doing the maths that, okay, if your recovery is going to drop by, 20%, 30%, right? So say in bucket 1, bucket 2, what does that also correspond in terms of what will be your increase into your credit cost as well? And I think that's a very important measure because in the end of the day, if say you expect an annualized credit cost of 3%, but see, because your recoveries are worsening and your credit cost is going to go from 3 to 4%, that itself is a 1% increase. Now, when you think about collections, that's very high in terms of the worsening you're seeing, right? And everything on collections besides the recovery is focusing on the cost to collections. So if you don't link your recoveries back to what is actually the impact that you're going to have on, in terms of your credit costs, it's very difficult to triangulate both of them. I think, while we say recoveries, I think the other very important thing to also look at is really looking at your bounce rates very early on and trying to see within your bounce rates that if you sort of break it up to your cohorts, right? So you break up your bounce rates to first EMI, second EMI, 4 to 6 months and everything, and start to see even within that, are you picking up some different trends, right? Because again, that might tell you something that actually macro is worsening because say all your customers in 4 to 6 months are starting to worsen, may not be a collections issue per se, but it actually can be a macro issue. So I think collections has to be a bit holistic in terms of recoveries relate a lot specifically to a collections metric. You got to break it up. But I think you have to always be able to link it back to how does that talk to your credit cost. And I think you have to add a layer on that in terms of your bounce to actually see whether is there a macro bigger picture that is starting to also show early warning signals when you look at the different cohorts as well.
Yeah, that's very important, I think. One of the things which, naturally when collections comes into picture is the entire concept of the firmness of collecting the money and the fairness of it. And there is a lot of regulatory compliance around it, but one is to meet the requirements, the other is, the spirit and the letter part of it. And it's a difficult one because the customer did take money from you and he's supposed to pay back. And if he or she is not paying back, there is a way to do it. But how do you kind of get that balance between, the recovery and the firmness, and possibly from your vantage point, how do you see that particular piece playing out?
So I think, the spirit of it is that the regulator really wants to champion, customer protection, making sure there's no harsh sort of customer sort of behavior, practices and everything in that sense, right? I think as a regulated entity, I think you've signed up for the sort of the responsibility where you have to sort of play with that rules. Now, what I mean by playing with that rules is that you have to make sure that your agents are, only contacting our customers during those hours. What's the code of conduct that your agents are going to have and everything in that sense. The key thing is, while you operate in the rules, the question is now, how do you enforce that rules and enforce that rules in scale when you have a large collections team, right? So for example, how do you make sure that, okay, you make sure that there's training that is done. You make sure that you're doing, audit sampling, call samplings, that the behavior is right. You make sure that if you find any negative behavior, you make sure you're taking the right action. So I think what it comes down to is that there is rules that you have to follow, which you have to then find ways that you are able to track it. But with that, how do you actually collect, right? So that balance within, sort of the balance within firmness and fairness. And today the customer is also quite smart, right? The customer also knows that if you slightly push it beyond here, I can sort of flag it to RBI and everything in that sense. But I think as long as you are operating in these guardrails of the rules you're able to monitor, I think you are still able to do your job in terms of collecting, but just making sure that there's no harassment of the customer for you to balance out the firmness with the fairness aspect as well.
Deepak, you want to kind of add to it?
So the way we see this is, given ours is a mix of on-rolls as well as off-roll employees. One thing which we do it without fail every month, or and in a very detailed manner every quarter, is listening and auditing the calls what our employees are doing. Because one is you creating this code of conduct. Second is to ensure that your vast majority of your feet on street as well as the outsourced employees, they follow that, because it's very important. And the rules are there for a reason, right? There would have been many practices which went beyond the way regulators wanted them to happen, and that's where the rules came in. So to adhere to those rules are very critical points, and we as a firm, from user experience point of view, right? Because for a few bad apples, you cannot paint and think that everybody is defaulting for defrauding you. So changing that mindset, at least, till that fraud is proven, or, you're absolutely certain that this defaulter has defaulted because of fraud and not because of the circumstances. You have to keep that customer experience in mind for sure. And we've again created tools there to train, to audit. Again, using some AI to ensure that we do some agentic calling in the early buckets versus manual calling, to ensure that the script is standard versus the script deviating from this. So multiple tools we are using to ensure that we stay in the right side of the arena of the rules here. Finally, see, this customers bureau is also getting impacted, irrespective of what you're doing on collection. So they're not getting another loan for sure. So that means that their financials are bad, and they are defaulting because they're not able to repay. Yeah, either it's that situation or it's a fraud. And till the fraud is not proven, you should not go in a very hard manner to go out and collect. Finally, we also look at offers very clearly. The behavior of us, basically, if they are they repaying other loans and not paying our loans? If they have other secured loans, because we are an unsecured loan, so are they paying those secured loans? If they are, then again sending the agencies to their residences, to the shops, to ensure that our payments also start, because the cash flow is then not an issue. They know that it's an unsecured loan, and thus they are behaving like that with you. So these are 3-4 things which we take care of.
Thanks. Brendan, you want to kind of talk about, from an omni-channel experience perspective, there is, telecalling, there is physical, there are messaging. You briefly spoke about the entire user experience part of it. How do you see that particular play happening in the collection space?
Yeah, I think it's one of the areas where it's going to work the best. I think picking up on Deepak's point from earlier, if a good collection starts in acquisitions, then fair collection starts in fair product design as well. So firstly, we start with a good product, but then with what collections is trying to do is trying to help somebody through a difficult financial time. We've cleaned out the fraud. Of course, the fraud we have to treat as fraud and go hard. But once we're left with those customers that are genuinely in distress, what all the regulations are trying to do is make sure we treat them basically like we would want to be treated. And in that sort of situation, it's not nice to speak to a human, face to face, but even on a phone, to have somebody who it feels like they're judging you, it feels like you're back in school in trouble for something, is a very awkward phone call to receive, and to receive while you're at work or while you're at home and the kids are going crazy. So what most people in collections want is a way to manage their finances, to correct their situation, but they don't like the fact it has to happen with another person at the time that another person decided. And that's where these agents and inbound channels are really useful. So what we want to do is have a way for a consumer to, on their phone, after the kids are gone to bed at night, they can sit down, maybe they got the laptop open, they can see what their bank account's doing, they can see what their budget is, and they can plan out without the stress around the phone call, and they can adjust how much they're paying. And I think where we can learn a little bit from the COVID days is that flexibility. I think that what happened with COVID, I'm not quite sure in India how it played out, but in the UK, one of the good things that happened was people from all over the economic spectrum went into collections. Your very best customer, maybe they owned a hotel, they were wealthy, suddenly no one's in hotels, they need some help. And it forced managers to think, okay, this isn't just the riskiest customers here, anybody could go through this, and we need to be flexible. So maybe somebody can't pay 100% today. Maybe they can pay 50%. And if we let them pay 50%, one, we're getting some money. Two, they feel empowered because they haven't missed a payment. As where kind of gamification comes in. But can we, in our apps or in our internet banking or whichever our processes are, have a way that the consumer can say, this is what I can manage, what are my options, can I pay you back over another month or two, but a little bit less each month? And so it's building flexible systems that work around the consumer. If your customer base is, Main Street, monthly paid salary employees, that doesn't matter as much. But certainly if you're looking at people working, self-employed, gig workers, people that have got up and down incomes, that's just good practice across the board. How do we make the payments, the way that we receive payments, as flexible and as easy to use? And yeah, for things like AI agents, you might get a phone call that's trying to sell you a product, and if it's a computer voice, maybe it doesn't really do the same sort of brand work as a human voice. But in collections, it's actually comfort to know you're talking to a robot. You can just tell the robot, okay, I don't have enough money, and the robot's not a human that can judge you. So I do think we'll see a lot of space in here, in outbound, but primarily in inbound, where then I'm not harassing somebody. I can send them a message in the day, click this link, and they can click it at 11 o'clock at night. They can click it on the weekend, and that's what worked for them. I don't have to justify for the regulator, and I can give them 5 or 6 options, and it doesn't feel like I'm bombarding them with information. So I do think it's an area that these sort of tools will do a lot of good for lenders and for borrowers.
So this is a nice segue into the conversation around AI. So, as I was kind of reading about AI for collections, one is the entire predictive model scene. Deepak did allude to that as well. And there is the piece about agents calling. So will this mean that tomorrow there will be nobody calling a physical human being and it will be all AI agents and AI predictive models? How do you see the use of AI apart from data sciences and in how collections 2.0 or the future of collections will be? So anybody?
I'll start very quickly there, but no, there will still be people. I think it's a case of the suite of offerings. You don't want your expensive, well-trained agent to phone somebody that would pay anyway with a quick message. So like we do today, like we'll send a text message instead of call. There'll just be a bigger pyramid, and one of the options will be give them a chance first in this manner. If that's not working, we will still, I think, always have agents. I think one of the first experiences I had of the boom in Indian call centers, I was working in collections in Kenya. I was in a hotel, and I met somebody who was building call centers. And he told me he could build me a collections call center staffed by people who spoke Kiswahili and would do my collections in Kenya cheaper than I could in country. And one of the interesting things is that people could pick up on the accent that the person didn't live there, and then basically said, well, you don't even live here. Why am I going to pay you my money? Yeah, come and get it. So it is hard in collections. I think you still do need a person that feels, in the end, yeah, they owe you money. So you still do want that, but I think it'll be a lot less.
Yep. Yeah, I think it's going to be very helpful, especially for the early nudges, because I think, building on what Brendan said, right? I think the non-judgmental aspect plays quite nicely. I was actually recently reading, and I sort of read something that said that AI, where people are using it for IVF, is actually going through the roof, because people actually find that they can really go into a lot of detail. So it's quite intuitive, right? That you want it to be non-judgmental in that sense as well. But I think the whole AI journey overall, I think it'll be quite phased out. I think for early nudges, it's helpful. But if you look at the second part, collections is all about who reaches the customer first. Right? Now, if I, for example, say that, okay, we're taking a very aggressive stand where, okay, we're AI this, AI that, and my sort of another lender has reached the customer, and we have not reached because, we've been doing this, we may not get paid, right? So you also have to balance some of this in terms of how fast you move versus what the others are doing, because that field staff that you also have play a very important role in terms of how you end up collecting. But I think where AI will end up helping a lot, AI can also help a lot with the productivity of the field staff, right? So, for example, the route that he goes to visit, How do you optimize it? The timing to collect, right? Going back to all the predictive analytics and everything. How do we monitor that field person, right? In terms of how many visits has he done, how productive and all. So I think overall, I don't think it's just like, okay, it's a button that, we just click this and everything gets automated. I think it's really dividing it, in the early nudges, very helpful, breaking it up for the productivity aspects. Those can also add value. So I think it's about stitching it up gradually versus it sort of fully changing it immediately in that sense.
For me, there are three aspects to collections which will be impacted to some extent by AI. The first bit, is the calling which we are talking about, and the way the technology is changing, and the way the cognitive abilities of the agents have been, evolving, the way it's happening right now. I think there's a high probability that most early calling can shift to agents in very near future. It's still not there, but it may happen the way technology is evolving. We can see a lot of that happening pretty soon. Because again, the ability of the agents to respond to the English which has been spoken, or any other languages which has been spoken, even the local languages, and multiple languages at the same time, is much higher than a human brain, right? So thus I see that a very, very high probability and a not very far outcome. Second area is the analytics bit or the insights bit on us of us. Again, the ability of machine to read and make sense out of thousands and thousands of variables is much faster and much smarter than human brains or human beings working here. So again, there, to whether he's paying someone else or what's the ability, what's the real cash flows, etc., through account aggregator and other data sources. So if machines are making those decisions of settlements, early settlements also, there may be a faster recommendation which may come. And then there is a third area, which is the agent, which is actually going on the field and doing that settlement conversation or closing the case. That bit, I think, and we are significantly away from agents or AI taking that over. But AI will definitely make that feet on street or the person going on the field much smarter than what he or she is currently.
Yeah. So as I see, the digital and omni-channel infrastructure basically would be the future of collections, be it today or maybe 2030 and beyond. So what I feel this, it is a combination of multi-channel, omni-channel ways, and no one way may be correct. Because you see, what my friend here tried to touch on is bucketing the collections into various buckets. For example, 1 to a couple of days, 30 days, maybe 90 days and beyond, taking cue from what bankers do. So if you see, so it will be a mix of channels, like it would be, SMS, IVR, WhatsApp, UPI, autopay, and things like that. What account aggregator can pitch here would be a little more futuristic here, would be that it gives an insight on customers' behavior. It is more of a predictive modeling. You'll come to understand the nature of customer, what the customer may do in the days to come by observing his portfolio, again, basic strictly by his consent. So that actually, if there are early warning triggers, for instance, for example, if you know that the person has been sanctioned a loan basis this assets that you viewed, and the credit underwriting was done basis that. And if there's a perceptible fall in the assets, which you observe, as I told you, you can actually observe 3 to 5 days a year, taking the customer's consent. So early warning signals will trigger remedial measures for folks. So the collection, if I may say so very outrageously here, the entire paradigm can change, what we are talking here. Imagine if you had a foresight much before it actually happens. You will take corrective actions much before they actually happen. So if you were to understand that we sanction this loan, let's say at this asset base, and you find there's a perceptible drop in that overnight or someday when you observe, you could probably recall a loan, may request the borrower to pay a little early, pay it, maybe restructure the loan. And the entire paradigm may change if advance warnings are there, unlike a credit bureau, which is basically a day in time. You see, credit bureaus reference your scores every 30 days, right? So this becomes a very big paradigm change, and as you correctly mentioned, this can be a very good use case for the loan industry going ahead. Thank you.
So Abhisar, as actually, that was the last segment where I was kind of wanting to ask about future of how you see collections kind of evolving. So, you've answered that part of the question as well. So thank you for kind of leading into that. So I guess we've limited time, so we want to kind of go to each of the panel members and panelists and ask them about how are they seeing this future evolving in terms of collections, and what do they think of collections 2.0? Is it all about the agents and the AI models and the variants around it, or is there something more which you also see coming in, or is that an ask saying that, okay, from a control compliance legal framework perspective, is there something more you want apart from SARFAESI laws and repossession and what's happening in NCLT and so on and so forth, ARCs? We didn't really touch about some of those, but real important legislation which has kind of helped the collections piece in a structured manner. And you did allude to it, saying that there is a law and we've kind of be there. But is there, from your standpoint, any ask or any vision in terms of how the entire collections business will change?
Yeah. I think it pretty much summarizes the themes that we were talking about, right? But I think overall, if you look at collections, how it was maybe 5 years ago versus today, it's changed dramatically. But I think it's coming back to the point now about stitching up, I would say, it's kind of like a workflow if you think about it, right? So I think the first part of the workflow is effectively data, right? So on the data today, it's not just going to be bureau data, but it's going to be, say, your banking data, transactional data, and everything. Using that data to be able to get all sorts of signals, right? Early stress, then using that to feed into your predictive analytics, right? Because I think sort of summarizing, the key part with predictive analytics is that not every customer is the same. Then using that next step, basically, which effectively means that your communication is very different, right? Your mechanism that you use to follow up, your intensity that you follow up, the messaging that you have is very different. So I think the communication is the sort of the third bucket in terms of the difference. And I think the last part of all of this is there is a massive monitoring aspect, right? So how do you enable, that, you're regulatory compliant, you're monitoring. So I would say that if I think of it, it's really the future is about, we've come leaps and bounds in terms of these 4 buckets, but now how do we get it that it gets stitched very seamlessly, right? That I think that will be the future in terms of how collections will also evolve for organizations.
Deepak, you want to also talk about the fact that we didn't touch that topic in terms of collecting, in terms of the options of collecting. Are you collecting primarily digitally, or is there still cash coming in, or is there a challenge in that aspect with UPI and some of the digital initiatives happening in? The understanding is that that part is reasonably sorted. The options to pay is sorted. Is that still a challenge, or that is not really the...
No, at least in the segment which we are in, the options to pay is pretty sorted. 100% of the collections is digital. E-Nash, Daily Nash, and then UPI kind of solves the payments issue for sure. Just adding on the previous question, and I kind of addressed the, through what I meant in various buckets, but machines are getting smarter, and so are human beings. Because the predictive insights which every small, every resource which is may or may not be as capable by formal education, etc. But that resource is the amount of data every resource is getting and being fed by machines is just increasing by leaps and bounds. Like the amount of data which I get to look at FlexiLoans today, I would have not got that 5 years back. So then that allows me to make decisions much faster and much better, right? So it's more informed decisions. So I think the early warning signals, we'll see many things like bureau reporting. It's already changing to go towards daily reporting.
Daily, 15 days.
Yeah, so the moment daily reporting happens, and then there are early warning signals which can be built in, and then your collection teams can act much faster. So many of these things will happen, and I'm only optimist as an entrepreneur about that the delinquencies and collections will reduce and collections will improve.
Yes, I think the one thing I'll finish on is, as you say, when I started work, we had the acquisition team, the portfolio management team in a lovely glass building in the financial hub of the city, and then us in collections were in a grimy old building in the wrong side of town. And for a lot of lenders, collections seems to work like that you've got the lending business, and then everything that goes wrong is left to collections to fix. And I think where we're at now is that good lenders will realize that with all these tools and data we now have available, that collections needs to be fully embedded in the same, and thought about with the same focus and the same sort of talent on it as any other part of the business. And the decisions you're making in acquisition, in portfolio management, who you give limits to, who you give a second card to, or whatever the case may be, that is also collections, and it's all connected. So we need these, like a connected data view, which AI tools can give us now, and to start planning ahead earlier and managing consumers a lot better. Also to build these much longer relationships. I think one of the collections problems in a financial sense is we're trying to collect one little bit of money and then say goodbye to the customer. If we recover them earlier, we've got a whole customer life ahead of us we can earn revenue from. So really good for the finances as well to get it right. But yeah, be friendly to your collections team, bring them back in. That would be my message.
Just to add, for example, what's happening now with local, smarter LLMs coming in, which you are able to deploy in your local ecosystem. With your data, now collections team can act much faster before they come to management for problem solving. So they can ask questions to the machines, and machines can tell them that, okay, in your entire collection buckets, these are the areas where you need to focus more versus focus less, and so on and so forth. So people are becoming extremely intelligent by the amount of data which is coming their way.
Do you want to add anything? Or?
Yeah, summing up what my three colleagues have just spoken, I think what we can do is, I think the key part is the technology will give you efficiency, regulations give you the oversight, and the pragmatism of sustainability will come through fairness to the customer. Because at the end of the day, if you see, all our regulators are very concerned about the dignity of the borrower. That is also very important. We should never lose sight of the fact that the ultimate borrower is a human being, and conditions may have had forced him to do what he has done in terms of, as you said, he owes money to us, so he better pay. But at the end of the day, it has to, all these, as a tripod, all these three have to work in tandem. Because if they don't, then you are actually on the wrong side of regulatory oversight. So having said that, it is important to ensure that all of this should weave into very simple sustainability, oversight, as well as efficiency by technology. Thank you.
Thank you so much. I think we're out of time, and this has been a very enriching conversation. If there has been any, there's a hand up. Why don't you? Can I ask a question? Yeah, of course. Go ahead.
Hello, my name is Abhishek, and my question to you is, with increasing technology coming in, how do you understand a borrower better? So how do you basically make sure that you treat a Swiggy driver differently from a Kirana shop owner to a software engineer? All three of them took debt differently, and they have different life aspirations, different goals, different things that they go through. So for example, an electrician have major family in UP, he works in Bangalore. He is facing a very different situation as compared to a software engineer in Bangalore. So with time, how do you profile customers non-quantitatively but qualitatively, and have a specialized mechanism for collections from them? How do you do that?
No, so this is exactly what I was talking about. You create cohorts of customers and try and create rules which are specific to cohorts. See, customizations to the T today is not possible because, again, if you do too many customizations, then the team which is eventually dealing with those customers will go mad. But certain types of cohorts, like within your customers, like in our customer segment, the way we do it is sectors plus a second variable of monthly turnovers plus a third variable of bureau profile, number of loans these customers have taken. These 4 or 5 variables we use, and then there are a few more. But eventually, you try and make cohorts of customers who have similar in these multiple variables I spoke of. And then obviously, if they delay, there's a method where machines will tell you that, okay, this is a high probability of default. Again, we've developed these scorecards because, again, we had thousands and thousands of good loans and thousands of bad loans as well. So we could now create scorecards which are working decently well for us.
What changes in messaging?
Yeah. So I could hear that. So messaging will be like, for example, if we have to nudge this customer to pay on time, because we see this a regular behavior that this customer is defaulting but repays in 15 days. Then the messaging to be sent via a robocalling, etc., is that this will impact your bureau and your ability to take loans in the future will get impacted. So do you want a change in your EMI dates? So why don't you take a repeat loan after X months of loans are paid, and change your EMI date because we see that you generally receive cash flows for this date, etc. So those level of customizations are possible today, but again, it all depends on multiple cohorts for us. It's slightly complex for lenders like her because she will have a consumer and MSME and multiple others.
But I think just building on what Deepak said, right? I don't think we are yet, at least for collections, we're not yet that, okay, you really will distinguish, say, like a Swiggy driver versus, say, an electrician and everything. I think that's a lot more in terms of how when you underwrite, because when you underwrite, you definitely build customer profiles in that sense. But I think what's very important is that in collections, where we are in terms of customizing the messaging, is really figuring out that with this borrower, based on the data that you've seen, how do you segment him, right? So is it a borrower that is, really has an intent issue, right? Willful defaulter, or, it's a cash flow thing and all. I think we have to bucket them in 4-5 categories, and then the messaging is customized, right? So maybe for a willful defaulter, you want to go on legal straight, right? It's not like you're going to actually be sending him WhatsApp messages, but maybe someone that you think it's cash flow, you might offer, say, some restructuring options or something. So I don't think collections has, at least to my best knowledge, has probably not matured that we are able to distinguish so well in segments. That's a lot more at the top on underwriting. Collections is really bucketing them into the various categories, and then you do the messaging for that.
Thank you, Abhishek. Thank you so much. Hi, I'm Nilesh Dasri. I'm from ICICI Bank. I lead the digital collection for them. As very well summarized by Deepak and Presha, that we require a lot of data to be built in for the data intelligence, to do the cohorting and profiling of the customers, to manage it more effectively, which is now becoming part of the collection as a part and parcel of the day-to-day activities. My question goes to Mr. Abhisar with something coming up on the account aggregator. While it is getting accepted and adopted on the lending side, where one consent or a single consent is obtained to use the information of the customer from various banks, there is a dual consent which is required for credit monitoring. And getting dual consent from customers becoming very difficult because they also know that this can be used for credit monitoring and monitoring their accounts from various perspectives, from the early warning signal or collections perspective. How do you see this coming up with technology becoming smarter and customers becoming much more smarter? Do you see this becoming one of the enablers or tools for collection coming forward?
So I work, because I've always worked with regulators all my life. I was a banker in ICC where you had joined. So I started my career almost with them. So let me tell you, what is good for the customer is good for the country. Please appreciate that. That is how the regulators work. So which typically means is that if it is not stated, it is not said. What typically here it means is that, for example, as you said, there will be two calls for that, which may not be required. What is evident here is the fact that, for example, if customer is seeking a loan for that particular period, for that particular tenure, for that particular amount, that's it. It is not beyond that. So if you see today, the way the consent artifact is actually designed is the fact that the customer is making a willful agreement with you that for this purpose alone it has been done. And I don't know if you've had the chance, I'm sure as a banker you would have gone through the new DPDP Act, which is a very far-sighted act, possibly one of the best in the world anywhere. So if you see, there are heavy penalties ensured on consent managers if they were to somehow try and seek shortcuts in that. So again, I'm reiterating the fact that the regulators go by what is good for the customer has to be done. And in a very, very humane manner, with the human dignity. So to answer your question, that may not last. So, and slowly if you see, repeat consents and all are actually being done away with, the fair use cases. I don't know if you have gone through that recent regulations that have come, and Samati is trying to drive some of them. Is because that if it is not required, it better not be done. Because for one particular loan, for that particular period, for that particular tenure, it has already been given. Why it has to be given twice, thrice for that? Just to increase the number of consent? No, that is not the idea. I hope I answered your question.
Great. Thank you so much.
Thank you.
If I just may add to that, right? I think what we've seen in our experience, so for example, on our unsecured business loans, getting the customer to use account aggregator, maybe to say provide bank statement, sometimes it's not very easy, right? So that may be, and again, because say we work with DSAs, we can get the bank statements on that. But where we found it to be very sticky is that you take the consent just before you do the loan dispersal. Now, the customer has actually really committed the entire process. Now, if you really identify the point where, he's not likely to give up because he wants the money, that point is very intuitive on making sure that even though you're taking 2 consents, high chance he will complete it because he wants to get the disbursement. So I think that's also what you have to do is process engineer the right point to make sure that you're able to get the consent easily as well in that sense.
All right, thank you so much for an informative and engaging session. Let's have a huge round of applause, everyone. Please rise for a group picture.